What is going on, everybody? This is your realtor, Mohsen Jaffrey, and welcome back to another episode of Keeping It Real Estate. Today, I'm super excited to have with me a really knowledgeable and helpful mortgage advisor that I've ever met, Fatema Railey from Vogue Mortgages. Fatema, thank you so much for coming out. How are you? And welcome to the show.
I am very good. Thank you for having me. I'm very excited to be here.
I'm really excited. I know we've been working alongside helping out clients for about a year now, but this is the first time we're actually meeting in person.
Yes.
And that too for a podcast. So I'm super excited. Just to get started, so that, the viewers can get, a bit of gist of who you are. How long have you been working in the industry, and what kind of motivated you to get into this industry?
Of course. Great question. I have been in the industry for 5 years, I would say.
Nice.
I've been an agent for 3 years, though.
Nice.
So my husband actually was a mortgage agent, and he's been in the industry for over a decade.
Wow.
So, it's kind of, the next step, in my career to probably join him, with mortgages.
Nice.
And fast forward to today, and here I am.
That's amazing. So how has your experience been with helping clients? I know you have a family of your own, so managing your time and schedule, how has that been? I know it can get hectic dealing with a bunch of clients all the time. So.
It's honestly been great. Before this, I was in a 9-to-5, right? Of course, you only do your 9 to 5, you come home, you have your time with your kids and stuff like that. But this is rewarding in so many ways, right? The flexibility is amazing.
Yeah.
Where we were just talking about this before, I can work from a parking lot.
Exactly.
And that's absolutely acceptable, right? I'm answering, emails, talking to clients, right? So the ability to have that flexibility has been incredible and amazing.
Yep.
And I love helping people, whether they're doing a mortgage with me or not, just having that conversation. Because every time someone talks to you or chats with you, you're actually learning something from them as well.
For sure,
right?
For sure.
So it's been a great ride so far.
Yeah. And you specifically, I know, and the reason why I was so eager to, work with you after Essen actually referred me to you, is because you're so, focused on education and knowledge and, just helping whoever, even if they're not going to you specifically for business, you would still be down to, hey, give me a call whenever you want. I can help you out through whatever. Getting into the juicy stuff, mortgages, interest rates, it's been on everyone's mind. It's the most hottest and talked about topics in the recent months. So getting into our first topic or question, I want to kind of understand the sentiments and the feelings of, home buyers, seller, and investors. In your experience in the past few months, or specifically with your clients, do you see a lot of people kind of waiting on the sidelines and analyzing the market, and they're saying, okay, we're just going to wait until the interest rates go down? Or on the other hand, do you see them kind of regaining confidence, getting a bit more familiar with the market and kind of diving into things? So if you can shed some light on that.
Of course. So I would say there's 3 schools of thoughts, right? The first one being people are really fearful of the rates, right?
Right.
You were at that 1% rate, just 2 years ago, and now we're at 6% in terms of rates, right? So
Insane.
Just that increase, has gotten people to sit on the sidelines and kind of wait it out. Then there's my favorite people who are waiting for the market to crash.
Yeah.
They're waiting
hear that
for
a lot. Yeah.
right. They're waiting for that, bottoming out of a real estate, picking up a deal that's going to come their way, right? And, every time you have a conversation with them, they're like, nope, we're waiting, the market's going to crash, and then that's when we're going to buy.
Right.
And then on the flip side, there's people who are ready to take action. So these are investors, buyers that are like, you know what? We're seeing deals and we're seeing investment opportunities come up, right? We understand that the rate's high, but I always say this: marry the house, date the rate,
Date the
right?
rate. Hey, that's nice.
You
I like
can
that.
get a 5-year variable and refinance, out of that. You can get a shorter fixed term rate, ride out, this a rate hike that's happening right now, right? And then once it's time to refinance, renew, you're probably locking into a better rate later on, right? But at least you're getting that deal on that house.
Of course.
So that's what we're really seeing. In terms of, buyers as well, buyers are more cognizant, they're more cautious now with their money as well.
Exactly.
So those are just things that we're seeing in our
because
industry.
for a lot of them, what I know is that if they were on a fixed rate before, their term is kind of coming to an end, or if not, if it's already ended. So now they're,
Shopping
they don't know what to do, right?
Yeah.
So yet again, as a follow-up question, what's the trend you're seeing right now? And I know you've probably been asked this a lot. In today's market, are you seeing a lot of people locking in at a variable or fixed rate?
So a lot of people now are doing a shorter fixed term rate. So they're
Mhm.
doing either 2 to 3 years. Because, as financial predictions are that, the economy is predicting within 9 to 14 months is when the rates are going to start tapering off. They're going to start dropping, right?
Okay, so we do kind of have a prediction.
Yeah, we
right?
do. We do have a
Because I
prediction.
know the Bank of Canada, after the last interest rate hike, they said they're going to put on a hold.
Yeah, but
with
once again,
I don't know, right? Like I was just discussing with Essen as well
Yeah.
before, like
Yeah.
they're making promises, but we don't know.
We don't know because they made promises a while back where they said that they weren't going to increase rates.
And
you know,
then bam,
and then,
bam, bam.
Yeah,
It's
we
just
had so many
consecutive
rate hikes,
interest
right?
rate hikes.
So I
Yeah.
can't even believe what the Bank of Canada puts out there.
Yeah.
But just, in terms of history and stats, we are seeing that 9 to 14 month mark. And so people are, opting for shorter fixed term
Mhm.
because there is a 1% to 1.25% spread between variable and fixed right now.
Right.
Where
right.
variables at like in your high sixes versus your fixed term like that 5,
Yeah.
mid 5, high 5s.
Yeah.
So definitely people are opting for the shorter terms.
For the shorter terms, exactly. Now, as interest rates have been constantly going up, I know this is a question I have as well because I deal with a lot of clients that ask me this, and obviously refer them to Fatema. So people are always finding a way to pay less than 20% down.
Right.
Right. Now, what I want to ask you is, in what situations is it possible to pay a less than a 20% down? And if you do so, if it does work out for you, what are some of the pros for it and what are some of the cons?
Absolutely. So you put less than 20% down when you're purchasing a property for under $1 million.
Right.
That's one. And it needs to be classified as a property that you're going to be living in. So it can't be a rental. If you're buying a rental property and it's classified as a rental, you have to put 20% down, even though it's under $1 million.
Right.
Okay.
So by rental property, are you meaning
like
for
an investment
purposes?
Property.
Okay.
Yes, an investment property. With that being said, so if you're putting less than 20% down, it's called a high ratio mortgage.
Got it.
Okay. And there's 3 major insurance bodies. There's CMHC, Canada Guarantee, and Sagen. So they go behind that mortgage and they say that, hey, bank, lend out money to this person, but we're backing them up. And of course they do charge a premium, right?
Right, exactly.
And, but it's good for people who don't have the full 20% down, right?
Exactly.
If you want to, let's say if you have, 70, 80,000 and for an $800,000 purchase, for instance, a 20% is 160,000, right?
Right.
But some people might not have that 160,000 lying around, right?
Exactly.
But if they can qualify and still pay that premium, it's still getting them, their foot through the door where they're entering and they're becoming owners of their property or their house, right?
Right.
So that's the positive, aspect of having or putting less than 20% down.
But to clarify that first point, if it is investment property or it's a property above $1 million, 20% down is mandatory.
That's correct.
Got it.
That's correct. The thing with high ratio mortgages is that it does come with a lower interest rate. However, because of the premium that you're paying, sometimes you might pay the same as if you're putting down 20%.
Right.
Another reason is we have something called amortization. So amortization can either be 25 years or 30 years. That's basically how long, typically it might take you to pay off your mortgage in its entirety. Okay.
Right.
With a high ratio mortgage, you're kind of capped off at 25 years amortization.
Got it.
Versus if you put 20% down, you have the option of either putting 25 years or 30 years as your amortization.
Right.
So really, that's the benefit of, or I guess, the benefit is that, you have someone backing you and, you can enter the market. But then I guess On the flip side, you are paying a premium.
You're paying a premium, exactly.
And,
It gets more expensive monthly, right?
Exactly.
So now, I know you were talking about the amortization periods. Now, because of higher interest rates, have you seen amortization, the standard length for that increasing as well now?
No.
It's still the same, right?
So it's still 25 or 30 years.
That's hectic for buyers. That's really hectic.
It is, because I think they were petitioning to increase it to 35 years.
Yeah.
But that hasn't passed.
And I
don't even think they're going to consider it. I think they're going to stick to the 25.
I mean, that's unfortunate, right? Like, I mean, I know you've probably read through a lot of posts and news articles. Like, so many people are just struggling right now. I've read where parents have to, they're left with no option. They have to take their kids out of extracurricular activities. They can't go out for that nice family dinner 1 or 2 times a day. Why? Because they're focused on not just paying the principal now, but also the interest rate. Yeah. So it is unfortunate, but hopefully, hopefully interest rates go down sooner rather than later. No, thank you. That was amazing information, because I know a lot of people have that question, especially a lot of clients get into the market. When can I pay 20% down? What's the pros and cons?
Absolutely.
Now, we were talking about investment properties before. As home purchase prices are decreasing and now they're much more negotiable, many homeowners are thinking of purchasing either their first investment property or another investment property, but they want to use the home equity line of credit, the HELOC route. So for those people that are hearing about this route or this option for the first time, I want you to kind of tell them what a HELOC route is. And if you're looking to go through the HELOC route, yet again, what are its pros and cons in today's market?
Absolutely. So a home equity line of credit, or HELOC as we call it, is a great feature where you can get access to capital quickly, right? It's basically leveraging the equity in your house and pulling money out. So, if you were to refinance, you would have to break the term, you would have to break the mortgage, you have to pay the penalties. For this, you just go to the bank and you say, hey, can I get a HELOC? I have a house, there's equity in the house, can you bet against that, right? They'll be like, yep, sure, we're gonna give you, let's say, 120,000. I'm just putting that rough number out there, okay? Great, you can use that, right, to then buy an investment property, let's say. You can use that to have renovations done in your house if you want. Even consolidate debt. Like if you have 5 credit cards that are all maxed out and you're paying like just interest only every month on those credit cards, you can consolidate that by, having this HELOC, right? So it's easy, you can get it as long as you're qualified, which is very important.
Yes, as long as you're qualified.
As long as you're qualified, yep. You can go to the bank as long as you're qualified and they say, that it's fine, then you can absolutely get access to this amount. I guess the flip side to HELOCs, though, is that, they do come with a rate premium. Right. They are more expensive than your
and they're taxable mortgage. As well, or
no, they're not. So it's just mostly you just have to pay. So it's like a revolving line basically. So you don't get the money up front. You can draw from it. So let's say you have 120,000 in a HELOC. I guess you get interest on how much you borrow from that.
Okay, got it.
With that being said, let's say there's some banks actually that might not allow you to put the entire HELOC as a down payment. They might say, hey, 50% needs to come from, let's say, from your HELOC, and then the other 50% needs to come from your savings. So it really depends on the lender and how they treat the down payment. And then another thing that you also have to be mindful of, a HELOC is a debt. Right?
Exactly.
So let's say, sure, you bought that property, let's say now you're buying your third property, for instance, right? There is a HELOC that you're servicing, right? So if you do buy that third property, your qualifications are going to go down because now that HELOC is a debt.
Interesting.
Right? Okay. So sometimes maybe refinancing might be a better option, right? Than having a HELOC. So that's why it's very important that the agent or the realtor, whoever you're talking to, you're setting yourselves up for success, right? You always have a long-term plan. If you're, a savvy investor who wants to buy multiple properties, which is the best way to go? Is it to refinance, pull out money, and then put that towards the next property? So it's kind of really important to sit down and have a plan in place.
Got it.
And yeah, sorry, go ahead.
No, for sure. And for this specifically, going for a HELOC, would you recommend, and obviously, it might or might not be biased, but going to a bank to get that loan or going to a private lender, what are some of the differences between that?
So for a HELOC, it would have to be directly with your
With the
bank,
bank, okay.
yeah. But if you're looking to get like just a loan from a private
From a
lender,
private lender.
they come with very, very heavy rate. Like, you know,
Right.
you're looking at like sometimes like anywhere between like 10 to 13% in terms
so
of,
that can be, that is a pricier route.
Exactly,
Okay.
exactly. It really depends on what you're trying to do. I think first, see if you can refinance if you want to buy that investment property. I know with the rates, you know, you kind of want to be like, oh, do I really want to refinance? Because you're probably going to lock into like a really high rate, but sometimes it might be worth it, right?
Yeah.
Depending on what your end ultimate goal
So
is.
typically for investment properties, the rate is going to be higher in comparison to the primary residence, or
yeah, it is just by a little bit because it is a rental property.
Right.
It does come with a little bit of premium, not such a big premium, but it does come with a little bit of a premium.
Okay, perfect. That was really informative. The next question is, and we had a discussion about this before, it's actually a really practical topic as to why I wanted to incorporate into this. When a client came up to me and she was asking if she can, you know, use her line of credit because her credit score is amazing, right? So she wanted to use her line of credit for, you know, for funds to come up with a down payment. Now, I wanted to ask you, especially for the younger generation that, you know, are building up wealth, building up, you know, their finances and whatnot. They're still worried about, you know, their savings and how they can come up with a down payment. Now, are there any tips or tricks or any, you know, routes that they can go through to, you know, any financial services that they can be provided to them to come up with the down payment? And if you want to also focus on, you know, the line of credit, because I know that's huge right now as well.
Of course. So the government does do an okay job, I guess, of providing first-time home buyers with some programs. So you have the RSP program where, you know, buyers can draw up to, like, each borrower can draw up to $35,000 from their RSP and use that towards a down payment. Usually you have to pay that back within the next 15 years.
15 years, okay.
So there's that, and it's not taxed, so there's always, you know, benefit to that, right? Yep. And then in April, they're coming up with another sort of similar type of product. It's like a savings, for first-time home buyers. Same thing. It's like a TFSA sort of RSP, like that kind of, you know, program that they're coming out with. And same thing, I think you can draw, you know, if you put money inside of it, you can drop to 40,000. So now you have access, you know, to more money. And it's not taxed, right? Because if you were to like draw money out of your RSP, you know, you would get taxed, right? So this kind of helps, you know, first-time home buyers when they're trying to, you know, put money down for down payment. There's always, there's always, you know, the mom and dad bank. Right, which, you know, you probably don't want to go to your parents, but you also, you know, our parents, you know, they bought properties for like 200, 300,000, and now their properties are worth like over $1 million, right? So they can always, you know, get a HELOC once again if they qualify, and they, you know, you can always use that, you know, money to put towards, you know, the down payment. So these are just some of the options that you could use, you know, to help you come up with that down payment. And then, you know, I always say this, even if you're 2 years, you know, from your first house that you want to buy, you want to purchase, right? Sit down with an agent, sit down with them, you know, talk to them, come up with a plan of how you're going to save the money, you know, where it might make sense, you know, maybe talk to a financial advisor, you know, maybe put money in mutual funds that can help you grow, you know, the savings that you already have, right?
Exactly. And that's what I said, sorry to cut you off, but that's what I always suggest to people before coming to me, go talk to a mortgage advisor, because with a lot of people, they might, because of the last market, when the market was hot, they had they weren't able to purchase a property, right? Because of how insane the market was. And so they've been saving up a ton of money for their down payment right now. And they have a bunch of money saved up for the down payment. However, because they're, you know, looking at the media, looking at what's out there, it's all a stigma, and they think, oh, the interest rates are so high, I can't afford it. But in so many cases, you can be, you know, approved with the amount of down payment that you have, right?
100%. So yeah, 100%. Yeah. So, you know, whoever that comes to you, I think that's the first step. Like, just just get a pre-qualification or get a pre-approval to see how much you can be approved for. And whether you want to purchase now or later on, at least you have a number in mind.
Exactly.
And
exactly.
you know, you can think
you have something to hold on to and move forward with,
exactly.
right? And that's what's important.
Exactly.
100%.
Exactly.
No, that was really informative. I just want to touch on the line of credit
Yes.
as well.
Yes.
Because I know a lot of people had that question. So using your line of credit, I know you can use that, but there are a few things to keep in mind when you are using your line of credit.
For sure. So for using a line of credit as your down payment, kind of works in your favor, kind of doesn't work in your favor, right? So yes, you're getting the funds from the line of credit. However, that line of credit is treated as a debt. Okay, so you may think, that you're probably putting the money towards the down payment, but then when you're getting qualified on the flip side, they use that as a liability, or the lenders use that as a liability and as a debt. Okay,
yeah, got it.
So a simple, $500 car payment, for instance, okay, can actually reduce your purchase price by 75 to 100,000, right? So adding a liability, like an LOC, can actually once again reduce how much you can purchase for.
Right.
So that's just something to keep in mind. It's like a catch-22, right? And also banks might also say that, once again, some of it has to be from your own personal savings, and then some of it can be from an LOC, right? So it really depends, right? So once again, run through both the scenarios with your mortgage agent to see which route kind of makes sense the most.
Makes sense, of course, for sure. Amazing. Now, the next question is really common today, and it's because of the market that we're in right now. A lot of people are either downsizing or, looking to move into a rental property. That's because they just can't afford the interest rates that's on top of their principal. So now, in the worst case scenario, if they do have to pay a penalty on either their fixed rate or their variable, can you just give some more information on that, on as to what the penalty would be?
Of course. So, if you are in that situation, I think, if you have a variable rate mortgage, the penalty is slightly lower. It's usually like the 3 months interest. So you're paying anywhere between $3,000 to $5,000, depending on what your interest payments are. For somebody who's, in a fixed term mortgage, your penalty is typically higher. So you might pay anywhere between $10,000 to $15,000, depending on how much is left on your term, what your terms are made of, depending on the lender. So it really depends, on the type of, I guess, whether you have fixed or variable. With that being said, I think once again, you need to sit down with an agent, with a mortgage agent, or even go to your bank. If you think that you're going to default, they might have options for you as well, right? So,
that might not be the last resort.
Exactly. And so sit down, have that conversation. But, like you said, time and time, it's just not only the interest rates and the mortgage payments, it's all the other things.
That's the cost of living.
It's the cost of living, right? So maybe it might push people to the brink, and it's sad. But yeah, like I said, talk to your bank, talk to an agent, come up with a solution. Hopefully you can salvage that property where you don't have to sell it.
So all in all, it would be, don't run to just defaulting on your mortgage until you ran through all your options and gotten all the advice that you can, right?
Yeah, absolutely.
Amazing. Now, for the final question is, I want you to discuss like a general guideline, or some words of comfort, hopefully for people looking to get into the market, or those people that are on the sidelines coming into 2023. What things can they keep in mind, and what advice would you want to give to them?
So I think real estate always works out. That's always, I have a vote of confidence that it's going to work out. I know we're in a very odd time right now. Very confusing times right now, to put it. But it always works out. And so, if you're looking to purchase, maybe it's not now, maybe it's in a few years, once again, sit down, have conversations. If you need to save, if you want to, get in contact with a financial advisor, maybe you can put that money, instead of just in your bank account where it's not really, appreciating, right? You might want to, invest it, in a mutual fund, right? So once again, sitting down with experts and having these conversations with them can actually help you come up with a down payment if you put it, in a savings account that's going to give you higher returns, right? And then, just different things. You just don't rule out the fact that the interest rates are so high that you're just going to sit on the sidelines and wait. But plan and think that it is going to get better, and real estate always does get better, you know.
Exactly.
So those are just my words that I want to, you know, give out to our viewers, especially first-time home buyers.
Amazing.
Don't be disheartened.
Don't be disheartened. I think that's the conclusion that we can get from this, especially in today's market. It's a bit, you know, there's a lot of hesitancy, fear, but, you know, always get your advice, always, you know, talk to the professionals and see what they can do for you. Perfect. I mean, that was all for the questions. Super informative, super helpful. There's a lot of things I learned myself that I didn't know before as well. Now, what I'd like to do for the second half of the show is a game of this or that. So it's 10 questions. There's gonna be 2 options, and you either gotta choose one of the 2 options.
Got it.
Blurt it out which one stands out to you. Okay.
Okay.
We're good to go.
Exciting.
You ready? Yeah.
Yes.
Let's go. The ability to travel anywhere, anytime, or living in your dream home without taking a mortgage.
The first one.
First one. Amazing. Number 2, coffee or tea?
Coffee all the way.
But we're drinking tea
I
right
know,
now. So.
but no. Chai has my heart, but coffee, I just need
coffee all
to
the
function.
way. Perfect. Number 3, winter or summer?
Oh, neither.
Fall?
Yeah, fall.
Fall?
Yes.
I'm a fall guy myself. Fall. Amazing. Investing in real estate or stocks? This is a no-brainer.
Yes. Real estate.
Of course. TV shows or movies?
TV shows.
TV shows. Comedy or horror?
Comedy.
Okay, nice. Instagram or TikTok?
Instagram. I can't navigate TikTok.
Yeah, we're still looking and studying in intense research on how to work through TikTok. The younger generations has taken over it. Number 8, dining in or dining out?
Dining out.
Dining out. Physical books or ebooks?
Physical.
Okay, and last one, which is the toughest one for people in our industry, giving up your laptop or your phone?
Oh, giving up my laptop. I can't give
Everything
up my
is
phone.
on my phone. Exactly. Perfect. Fatema, thank you so much for taking out time and joining me and answering so many questions that, you know, a lot of people might have had and shedding light on some of the most hottest topics right now. Guys, thank you so much for tuning in. I'm going to be dropping Fatema's social media handles in the video. So if you have any questions, you need help, advice regarding mortgages in today's market, feel free to hit up Fatema. Thank you so much for tuning in. Until next time.
Thank you so much for having me.